This video is a GMX tutorial. GMX is a decentralized exchange built on top of Arbitrum and Avalanche. You can swap tokens on here, but the main usage is as a crypto futures trading exchange. We're going to go through how to trade on here, how to think about opening and closing positions, and also looking at the tokens themselves, because GMX actually has two tokens, GMX and GLP. What are they and how do they work? And how do we actually use this exchange? I'll leave timestamps for everything down below. We're going to connect our MetaMask wallet to GMX. So come to gmx.io. I'll leave a link in the description to GMX as well. They give a 5-10% discount on trading fees. If you want to use that link, you can. Then launch app right here. So come to the website, launch application. And then in the right-hand corner, we're going to connect our wallet. Now, if you don't have a MetaMask yet or a wallet set up, I'll leave some videos in the description that goes through setting up a MetaMask step by step, so you can see that video separately. Assuming you have a MetaMask though, we now need to connect our wallet, and we need to choose one of the two networks. In the top right, you can see Arbitrum and Avalanche. You can choose whichever one you want. I think the application is more popular on Arbitrum, and so that's the one we're going to look at in this video. And then we're just going to click Connect Wallet. Now, if you have a MetaMask set up or one of these other wallets, just connect it easily. You can see here, actually below my head, if I get out of the way, you can see your wallet is not connected to Arbitrum. Now, if you have maybe Ethereum mainnet on your MetaMask, which you should have if you've just set it up, then you're going to have to connect it over to the Arbitrum network or Avalanche. So if I click Connect Wallet and then MetaMask, I'll just click Switch to Arbitrum in the bottom right, and you can see MetaMask switches me directly over to Arbitrum, so I don't need to do anything else there, and it says connected to Arbitrum right here. And then I can go to Connect Wallet again, MetaMask, and it connects me in the top right hand corner. Now, if you don't have a MetaMask set up with Arbitrum or Avalanche, here's how to do that. So the first thing we can do is come to MetaMask and add it ourselves. So come to your MetaMask extension, expand it to this view, and then click here, click down to settings, and then go to networks, and you can add networks here. If you click up here at add network on the top right, it should be here if you haven't added it already, and you can just click add. Now, if it isn't there, click add a network manually like this. Click this, and then you need this information here. So what you can do is go over, actually within GMX, they give you this tutorial as well, but you can go over to the Arbitrum bridge, or just type in Google how to connect Arbitrum to MetaMask, and you'll be given this information right here. As you can see, network name Arbitrum1. So go and fill this in, Arbitrum1, and then you need the URL here, which is the RPC URL. You can just copy paste this, the chain ID and the symbol, copy that in, paste it here, and then click save, and that network will be added for you. Now what you can do is go back to your main page, come up to the top right, and actually switch between all of your networks. And you can see I've got a bunch of them here, and I'm on Arbitrum right now. So once you're on Arbitrum, then you can actually just go ahead and connect that to GMX. Now for Avalanche, it's exactly the same thing. Just go to the Avalanche documents, search for how to connect the Avalanche site, and this is the information right here. And so you can just put that in your MetaMask in exactly the same way, and you can switch over to Avalanche as well, wherever it may be, and then you're on the Avalanche network, and then you can actually connect that to GMX itself to trade. The next thing we need to do is get some gas tokens over to our wallet. Using GMX, it's a decentralized exchange, and so you do pay gas for each transaction, albeit a very small amount on these networks. So Arbitrum actually uses Ethereum as its token, its gas token, so you need to buy some ETH, and Avalanche uses AVAX, and so you'll need to get AVAX into your wallet there. I've got a tutorial on using Avalanche, the wallet, setting it up in MetaMask as well. I'll leave that in the description. But for Arbitrum as well, what we can do, go over to our wallet. It doesn't matter whether you're on Ethereum mainnet or Arbitrum, your wallet address is actually the same. So I'm going to go over to Bybit and actually buy some ETH right here and withdraw it on chain. So I'm going to choose the chain type, as you can see, and choose Arbitrum1, and then put the amount in there that I want to withdraw. Put your wallet address and withdraw that from the exchange as you normally would. Now, if you have some ETH on the Ethereum mainnet in a MetaMask wallet already, you can use the Arbitrum bridge to actually bridge this over to Arbitrum and not go through an exchange. What we can do is go to the mainnet right here. So we'll have to just swap that over in our MetaMask, and then we can swap from ETH mainnet here, so we can put an amount in. I've got a balance, so 0.05, and I can switch that over to the Arbitrum 1 network. As you can see, you do have to pay a fee here to bridge that over. It actually is usually cheaper to send the Ethereum directly into your exchange as an ETH transfer, and then go over to your exchange and withdraw it directly over Arbitrum if that is supported. Bybit do support this. This is a cheaper way of doing it than using the Ethereum bridge that I've found. GMX charges trading fees on the entry and exit of trades, 0.1% on each leg. So that's 0.2% in total fees for the open and close of a position. Now, as you can see here as well, if you are closing positions, especially with leverage, which require a regular swap from one asset to another to pay off the leverage, then the fee can be anywhere from 0.2 to 0.8% of your collateral size. So if you're opening a futures position, you pay for the futures position and leverage with your collateral, you'll get paid a little bit of a fee if you're opening and closing. That requires trading from ETH into USDC to pay off a short, for example, or something like that. So just to be aware of those fees. Because GMX is a decentralized exchange, it takes its price feeds from oracles within Ethereum, namely Chainlink. So as we can see here, we can actually trade just a few assets for right now. Mostly ETH and BTC are traded here. You've got Link and Uniswap to trade as well. So you can click on these to change. Now BTC here is wrapped Bitcoin. So if you want to trade BTC, you would need to get wrapped BTC over to Arbitrum in your account here. We're going to go on ETH right here. We can see the price itself. Now this is the mark price. If you're trading futures, the mark price is the official price of the contract where it's trading at. That is where all of your trades will settle, and if any liquidations occur, it's the mark price that will be used right here. As you can see, that is the only price given because it is an oracle price and it's not an order book price as you would get with centralized exchanges. Also, we can see a trading view chart here. So if you want to know more about trading and charts and analysis, I'll leave some links in the description that go through that in a bit more depth. My trading course has about 50 plus videos on that as well. So I'll leave that link down there. But what we can do very simply is come over to the right-hand corner and we can enter market orders, limit orders. And then if you want to use stop loss and take profits, you can enter these via trigger orders. But there are some caveats to using these as well. So I'll go over that during that section. We'll go through a sample long trade on GMX then to see how it works, and we can put an amount that we want to pay in. Now, as you can see, you have market and limit orders. So yes, we can put a price in that we want to pay or put a limit order in that we have, and then just choose an amount that we actually want to trade like this, and it works out the dollar amount for you, so you don't have to work that out manually, which is obviously good. And then we can choose the amount of leverage that we're taking. Now, it allows you to take 1.1x leverage as the lowest, and it goes up to 50. 50 is obviously insane. I don't recommend trading on leverage for anyone, but obviously I'm just showing you how the application works. You can see your trade details right here, including entry price, which would be $1,500 if our limit order goes through. You can see the liquidation price. This is the main thing on GMX, is that you need to be aware where your liquidation prices are and make sure that the liquidation price is well below your stop loss, because if your liquidation price gets hit, this is a decentralized exchange, and so you know, it's difficult to edit orders very quickly. You have to go through those approvals and stuff. So just keep that in mind. You can see the fees right here as well. Now, the more leverage that you use, you can see the fees ratchet up because you're essentially creating a larger market position. You're borrowing more money in order to have that larger market position. And you can see the liquidation price moves up. So the more leverage you're using, your liquidation moves up much higher to your entry price, because what you're doing essentially is putting some money onto the system, some value onto the system here to fund and collateralize a margin loan position. And so that fund that you have, that you've actually paid, the real asset that you have here, is simply being used to fund any potential losses. And the more leverage that you use, the higher or larger that the market position is, the closer the liquidation price is, because you just have less actual value as a percentage to back your losses of that massive trade. So we can just put this down. You can see the liquidation price moves far away. You have some other options here. Now, as you can see, there is a borrow fee as well. So you do have to pay this when you're going long, as you can see. It's calculated as assets borrowed divided by total assets in pool times 0.01 per hour. So this is something you do have to pay when you trade. It is a small amount, but it is something worthwhile just knowing before getting into trades that will be coming out of your P&L as well. So what we can do here is use a limit order or just simply a market order. So we're going to put in a market order here and just pay this. And then we're going to use a very small amount of leverage. Now, as you can see, min order 10. So I'm just going to have to change this 0.008 like this. And that will go through. Now we can enable leverage here. So I'm just going to do that. And then we'll have to just confirm that in our MetaMask to actually enable us trading this. As you can see, that costs 9 cents. So pretty cheap on Arbitrum right there. And that should go through pretty quick. Leverage enabled, that's just below my head, as you can see in the bottom right hand corner. And so we can now go and long ETH. So let's take a long position in ETH and click that long position, and we pay a certain amount, and we are longing a little bit more because we're taking that very, very small amount of leverage. You can see the liquidation price here around $720, 719 spot one. And then the spread here is 0. There are no spreads on GMX because they use the Oracle price. And then the allowed slippage, that is the difference between when we actually press trade, when the the trade actually goes through on the blockchain. There might be a small change in the price, so we're allowing 0.3% change, which is usually fine, especially for big assets. We are having a small blockchain fee in here as well, as you can see. So we're just going to press confirm like that. And that should actually submit a long position for us. Now, down here, we can see our open position, right? So we have our positions, we have orders that are in, which may be limit orders that haven't executed yet, and then any trades as well. So we're going to go to positions here. Now you can see we have an active position. So ETH, and we're 1.1x long in this. You can see we're losing 2 cents right now. You can see the size of the trade. So this will be the, depending on how much leverage you're using, this will be very large or small, and it'll be a 1 point something x your actual net value, right? And your collateral that you've used. So the size depends on how much leverage you're using. That is the market size of the trade, what you've actually placed. And you can see collateral here, and you can edit that, which I'll get onto in a second. See the entry price and mark price for our trades here, and our liquidation price. You can close and make some edits to this trade if you want to. Just like trading futures on centralized exchanges, if you want to add collateral to a trade, you can do that. So let's say that the trade is actually coming down and you're making a loss and you're about to get liquidated. Well, of course, you can actually pay off your leverage and pay off your loans and put more collateral into the trade. And that means that you won't get liquidated because you're essentially paying off the trade, paying off the leverage with fresh assets to bring down the leverage that you're using on your trade. So what we can do is go to collateral here and then click the edit amount. Now, as we can see, you can either deposit or withdraw assets that you're using as collateral from the trade. And so what we can do is press max, and that will deposit the max amount in my wallet. If you want to do that, right, just say, oh my God, I'm going to be liquidated, put the max in, or you can choose an amount to actually deposit there. So maybe I want to add in, $5 or something. So you'd work that out, 0.005 or something like that. You'd put that amount in. Now, as you can see, min leverage is 1.1x. And so that is my min leverage. And so I basically can't pay it off anymore, right? So this is just something that happens with GMX and decentralized exchange for right now is the min leverage allowed is 1.1. So you can't pay off to get maybe half of this. This kind of is it. And you have to have that trade open. Now, if you want to actually get out of this trade, you would have to close this trade now. So what we do is just go to close. As you can see here, you can edit collateral. But what we would want to do is close the trade. Now, what this would do is trade out of the entire position for you. So rather than paying off leverage, you can close it, you can get down to 1.1 and then close the trade. So let's click on close. We can see this right here. So we can close the max and then we can have a market order. You can see you can allow a little bit more slippage if you want, but you don't have to. You can see the order details right here. So we're going to click on close and we receive this amount back. You can actually select a token, so you can actually receive back a different token into your wallet. Now, important to know here is that what would happen here is that you would go through a normal swap. So this would be part of a bundled transaction where you're closing your collateral position and you're using some of those assets and that value to swap into a different asset. Important to know here is that if you did want to do that, you would have to pay these swap fees, which are going to be around about 0.3, something like that %. And so that's just to prevent free trading on the system, people kind of gaming the system. So if you want to swap it into another asset instead of getting ETH back, you can do that, but you do pay a slightly higher fee. I'm happy to just close this order and get ETH back. So I'm going to click close. That should go through to another transaction. So we'll just confirm that right here. And that should close me. And there you go, closed. So I now have my ETH back and I have no open positions. If you want to take a short position on GMX, you actually need a stable coin to do this. So when you take a long position, you can long with ETH itself or wrapped Bitcoin. But when you take a short position, as you can see, the collateral here, just above my head, the collateral is USDC, USDT, and these other stable coins, right? And so you need one of those. Now, there's two ways to go about this. The first one is to just use the swap feature first. And so get your ETH or other assets that you have, and then type in an amount that you want to trade into one of these stable coins, USDC, USDT, as you can see here. And then you would obviously make that swap, and then you'd get the stable coin in your wallet. Then you can go ahead and short directly with that USDC. So you can put an amount in that you would want to short and the asset that you want to short here, as you can see. The other way to do it is just to simply choose Ethereum here. If you have ETH, choose an amount, and that collateral you can see is still USDC. So what's going to happen is that the system's going to go through with a trade where it trades ETH for USDC, and then USDC, that's the collateral to then short the ETH. So you can do it either one of those ways. You can either do it first, or you can just do it in one transaction here, but you are going to still be paying the fees to actually transfer the ETH into USDC. Once you have that short position there, you can just obviously choose any amount that you want to short, and then just short it right here, and you have that open position again. You can use stop loss and take profit orders on GMX. They're called trigger orders. If you use centralized exchanges, you may know these as stop orders. It's exactly the same. So you have to open a position first. Once that position is open, then you can actually click close like you saw me do earlier, and it will display the option set for trigger orders. So you don't actually close the order itself. The order will be still here. So if I still had that long position, that would be here. You would click close right here, and then you can see the option for trigger orders. Now, trigger orders are something you put in, and they are market orders. So they're stop orders. And so essentially what you're telling the system is, I want to either buy or sell at a specific price. Now with stop loss and take profits, you would be selling at one of those prices. So you'd be selling a specific amount at a specific price. And it's called a trigger order because once that price is reached, let's say I wanted a stop loss in here and I wanted it at 1640. I'd go down to close and choose a trigger order to sell the amount of my order, which was I think 0.008. And that would be a sell order at 1640. Now that trigger order is a market order. So if the price gets down to 1640, that trigger order will actually be triggered and executed, and it will put in a market order at 1640. Because it's a market order, it doesn't guarantee the price that we trade at. We are just triggering that order to open at 1640. And if it's coming down, that market order may trade somewhere around 1640, but not necessarily at 1640. So that trigger order is a market order and not a limit order. But that is how you put in take profit and stop loss orders. You just put those sell orders in, you click close here, and then you can put the trigger order in at that specific price that you'd want the stop order at, the stop loss below or the take profit above. The other thing to note is that once you have those trigger orders in, if you close a position, so if you just completely close out your position, if I was long ETH and I close the position, those trigger orders would not automatically close out. On centralized exchanges, they do, but on this system, it doesn't. Those trigger orders will still be there. And so if you don't close them manually, they'll be there waiting to execute, and that may affect other trades that you have in place. So what you can do is just make sure that if you have any open orders that would be in here, that would be trigger orders, you'd have to manually cancel those out. Even though the position, your main position, might have closed already, you have to manually close those out as well after you close the original position. GMX also has two tokens, and I'll explain the difference between them right now. GMX is, as you can see, the utility and governance token. So GMX is essentially an investment in the protocol itself, and it accrues 30% of the platform's fees. So if you just want to invest in GMX and you think it's a profitable protocol and a good business, you can buy the GMX token and essentially get 30% of generated fees back to GMX. Now, GLP is very, very different. GLP is, as you can see, the LP token or the liquidity provider token, and it accrues 70% of the platform's generated fees. However, there are some things to know about GLP. So in order to get GLP, you can buy GLP itself, but GLP is a representation of the liquidity of the protocol. And so as we can see, if we go to the dashboard right here, you can actually see GLP, what makes up the value of GLP and how it accrues value. We can see that most of GLP right here is USDC, ETH, as you can see, and wrapped Bitcoin. That makes sense because that's the three coins really that 90% of people trade on here. And so if you're buying GLP, what a lot of liquidity providers do is they actually swap one of their main tokens like ETH or Bitcoin, and they swap it into GLP. Why is that? It's because they are actually providing liquidity onto the system for people to trade with. And because they're doing that, they get rewarded with 70% of fees. But of course, there are downsides to that as well, in that you are now swapping one of your assets to GLP. Also with GLP, if there are any bad debts in the platform, and that is something that can occur, that will come out of the GLP pools as well. So the liquidity providers do get an incentive to actually provide some of the value of their tokens into GLP. GMX doesn't have that. GMX simply accrues 30% of the fees, and it's a way to invest in the protocol itself. GLP is investing in the liquidity provider aspect of it. So that is the two differences between the tokens. If we just go back to the two tokens here, they do have different tokens for Arbitrum and Avalanche. So depending on which network that you're on, you'd have to buy a different token for that and then put it in your respective wallet. So as you can see, GMX here, you can buy on Arbitrum. It's available on all of these decentralized exchanges. So if you went through to Uniswap here, you would just be able to transfer, we can do understand here. We can do ETH, and then we can just, swap that into an amount of GMX, and that GMX is in your wallet straight away through that transfer. Now what we can do is go back to the Earn tab and then click Stake. So with GMX, you would have to stake it to earn the 30% of trading fees. The APR right now is around 6.86%, as you can see. So you would click Stake right here, and then it would say how many GMX do you have. You can see enter an amount. So you can just stake that right here. Now, once you're staking your GMX tokens, you are earning 6.86. Plus, as you can see, you get this escrow GMX APR. So as we can see down here, there is escrow GMX. So this is a way to split up the rewards that you're getting to essentially prevent people just selling out of GMX straight away when they get their rewards. There will be an amount of this, which is an extra bonus, as you can see, that goes into your escrow GMX. Now you can stake this as well or unstake. If you want to unstake escrow GMX, it actually unstakes over a period of 365 days. And so it's a way to kind of slow the redemptions down. You also get something called multiplier rewards, as you can see here. This is another bonus dependent on whether you're staking or not. So you can boost your rewards with multiplier points. More info here. So let's click on this. As we can see, multiplier rewards accrue at a fixed rate. 1,000 GMX staked for 1 year would earn 1,000 multiplier points. So again, the escrow GMX and the multiplier points are just ways to try and prevent people from just getting all of the rewards and then selling out straight away. So they're trying to make people actually stake for longer and accrue and compound those rewards and get better rewards rather than just selling out their GMX rewards straight away. You can swap your assets into GLP as well if you want to provide them as liquidity and get the GLP rewards. That will be down in your dashboard here as well. Current APR 21.39%. You can buy a GLP here. It takes you through to this page. This is essentially swapping, right? One of your assets that you're providing as liquidity, you're now putting into GLP. So let's go over to ETH right here and the amount of GLP that you want. Now, fees that are charged by GMX actually change depending on how much demand there is for that asset. So for right now, the trading fee is very low, 0.19% to swap ETH into GLP. However, if there is a high demand for one asset over another and there is a mismatch in the liquidity of the platform, then there are going to be incentives to swap the asset that the platform actually wants. So you'll get lower fees for that. And if the platform really doesn't need one of the assets because it's kind of over collateralized in the system, it's going to punish you by having much higher fees in that case as well. So the GLP token is really trying to balance liquidity from buyers and sellers in the platform to make sure that it's balanced. And so those fees may change a lot depending on when you actually swap one of those assets into GLP, depending on what asset the platform actually needs at the time. You can also sell out of your GLP back into the asset that you want. But again, depending on supply and demand at the time, you may get a really bad trade and high fees because they actually need that liquidity. So that's why GLP offers more yield, because there are more risks involved. You can purchase insurance as well. If you want to click this, it goes through to purchasing smart contract insurance, because GLP is on the hook for the liquidity providers and the traders. Anything bad happens, if there's a bad debt, GLP is on the hook. And so it's a riskier token and has higher rewards because of that. I'm not making any assertions about the quality of either of these assets, but that is how they work. If you do want to go ahead and trade on GMX, that link gives around 5 to 10% discount on trading fees, so you can try it out. That link is in the description. Other helpful videos down there as well. I'm James, it's MoneyZG. Cheers for watching, and I'll see you in the next one.